IVM.
Now, when someone, let's say I'm coming to you as a client and you're the advisor, and all I want from you is just tell me how to make 30% a year.
Right.
Okay, that's obviously I don't know whether you offer that service. If you don't, what do you tell such a person? I mean, how do you explain to him? At least this is my point of view, because I've written again about this in my book, that the rate of return on your portfolio is actually the last thing that you should be concerned about.
Exactly.
Right? You spoke about asset allocation. Can we just go into that for a while?
Yeah. See, it's like if you put in too little money into something which will give you a very high return. Anupam, what difference will it make to you in your overall life? Okay. So somewhere I feel that people are so disconnected with their life goals and with their overall objective and what they expect out of their money. There is like a huge disconnect. So they'll come with, like, say if their net worth is 10 crores and they'll ask you that if I invest this 2 lakh or 5 lakh and if I get 30% return, I ask them that a 30% return, 72 divided by the rate of return is a number of years in which your money doubles. Okay, so that means your money is doubling, say every 2 years or 2.5 years. Then in that case, this 2 or 5 lakh will become, will grow, and still it will be like, say in 10 years, 50 lakh or 1 crore. Till that time your net worth is X. What will it make a difference in your overall net worth if you invest a very small amount of money in a asset class which gives you a very high return? Okay, so what you need to be focused on is the asset allocation. And eventually, what is a goal of investing? The goal of investing in the growth assets. So I would like to put it like that we have the growth assets and we have assets which are for capital preservation or earning a little more than inflation.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter. And in today's episode, I'm talking about financial planning, financial advisory, financial wellness, financial well-being with Nehal Mota, co-founder Finnovate. Nehal, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
Thank you so much, Anupam, for inviting me on the show, and welcome to all the listeners.
And thank you. It's always good to have a woman, a lady in the house, because we don't have too many of them in the profession. And of course, so let's start from there. Tell us about Finnovate, your own background. What does Finnovate do? How did you start it?
So I've completed my post-graduation in management way back in 2002. And I joined financial services with ICICI Pru Life. I was there for about 2 years, worked in the bank insurance industry. From there, I moved to IIFL, where I was exposed to wealth management. And somewhere in 2007, just before the financial crisis, we decided that let's get into doing something of our own. And I had like a very big personal reason to it. 2001, while I was doing my management, I went to my native place in Bhuj, Kutch, where I witnessed one of the largest earthquakes and survived that. And when I was actually over there, one thing which I just saw life so closely and how in few minutes things can change. And one thing which I prayed was that once I reach safely back to Mumbai, I would want to do something out of my life and contribute back to society. And that's where I decided that I want to get into entrepreneurship, because it's a good way to give back to society, create jobs. And that really pushed me to set up Finnovate in 2007.
Yeah, I mean, it's like you've worked towards the dreams come true.
Yeah.
Fantastic. And iPro Life, IFL, so you've spent time in the financial industry and now Finnovate. So just for our listeners to understand it correctly, what would be your regulatory status? Because there are lots of people out there who are financial advisors, practitioners, professionals, advisors, etc. So what is Finnovate?
So we started as a distributor of financial products, particularly mutual funds, insurance and all. And then when the regulations opened up in 2013-14, we got into financial planning and eventually got our RIA license some 3-4 years back. So gradually we progressed from being a distributor to now being advisor and having a holistic approach towards managing money. And like you said, that we spoke about financial well-being, financial fitness. So right now, Finnovate has actually remodeled itself to be India's first financial fitness platform. And when I talk about financial fitness, what I mean is that investing is just one aspect of your financial life. Okay, we look at a financial life from a holistic perspective where you need to understand your financial life goals. You need to understand budgets, taxes, loans. Every objective of every person is to become debt-free. Investing, definitely. Risk, so insurance planning, and at last but not the least is estate planning. So we say that personal finance rests on the 6 pillars. And when this 6 pillars is balanced, that is where you can achieve financial fitness. And so we call ourselves as India's first financial fitness platform.
Recap the 6 steps to or 6 pillars to me again, just for our listeners to know.
Okay,
that.
so the 6 pillars is that the first thing is understand your life goals, and all life goals have money or money decisions attached to it. So goal planning.
Yeah.
The next is budgets. Now, whether your income and expenses are adequate to support that goals, or do you need to cut down on your expenses, or do you need to find ways where you can really push your income higher? So budgeting, taxes. Then everybody's objective is really to be debt free at some point of time in life, right? And so understanding what is the kind of debt which you have, what is your net worth, and making a plan to really get debt free by a certain age. Okay, so that was the fourth pillar. Investing itself, asset allocation. So whether investing in which asset class, equity, debt, real estate, gold, what will get you closer to your goals, depending on the time which you have, the risk appetite which you have, the knowledge which you have, and the amount of time you can spend on managing your money. So the investing per se, everything will not work if you do not have adequate insurance. Okay, so insurance is also an important decision and planning for it. And last but not the least, all this wealth we are creating so that it can go to the people we intend very smoothly. And so estate planning is also one of the pillars.
What do people do normally, and what is wrong with that? Like, if I look at myself, my only question would be, how do I get rich? Obviously, that's what's on everybody's minds. But what, in your experience and the people that you've met, what is the approach that they follow, and what's wrong with that?
So generally people earn, they spend, and whatever is left, they will save. And also whatever is left, they will save. That will be very random decisions. One of the days you would decide that, okay, I want to move in a bigger house. Or you just see like a new car and you want to buy it. And right now with this whole social media, celebrities really flashing their lives on social media. Everybody wants to really wear what latest celebrity wore for their wedding, or they want to holiday at an exotic destination. But what we need to understand is what is their net worth, and what percentage of their net worth are they spending on their weddings or on their holidays or their lifestyle. And we cannot just blindly copy them or mirror them. We have to understand what is our net worth, what is our expenses, what is our income, and would our income support that kind of a lifestyle. Okay, so these are decisions which you need to keep in mind before really getting into expending or spending or getting into investing. So people don't keep all this in mind. They're very random and ad hoc decisions. And the third thing is that generally investors chase returns. Okay, returns, the asset allocation, and your time to the goal, your understanding of why you have to save money is more important. Once all that is placed, why you want to invest, if that is sorted, then returns will automatically follow. If you stay invested in the right asset class for a decent period of time, returns will follow. So these are few things which, the mistakes which investors commonly make when it comes to money decisions.
Yeah, so I'm going to occupy two positions for this next question. One is, as a client or a customer, how do I make sense of the entire financial advisory system, right? Because for me, let's say I realize that I want to start taking steps towards financial wellness, financial well-being. I wake up one fine day, but who do I go to? What do I do? Because the financial advisory ecosystem can be a little bit confusing for a lot of people. I myself have had queries from so many people about so many things. Obviously, I'm not qualified. You are, for example, because you've passed your exams, you are an RIA. Do you just explain to our listeners what is the advisory ecosystem like today?
Right now, most people start with actually taking financial advice from their friends and family. That's like the first point. Either their parents or their spouses or their colleagues or their friends. That's the first point where they will discuss some, okay, I want to make investments or I want to save taxes, and the random advice will start coming in. The second place is right now bankers. A lot of people get financial advice from their banks.
Correct.
Okay, and then after that you have the insurance agents. So, in terms of the people whom you meet very often to get financial advice. Then it's the insurance agents. Then it is like the MFDs. And at the last, of the spectrum is when you come across a financial planner or a genuine advisor who will look at your overall financial life in a very holistic way. So this is currently the ecosystem. And if I were to share some numbers with you,
Please.
we have about 7 to 8 lakh active insurance advisors. As per the recent data published by IRDA, we have about 1.5 lakh mutual fund distributors. And if I were to compare it with RIAs, about 12 to 1300 people had got their RIA license. And just in a very recent conference, the SEBI chairman spoke about that 35% of these people didn't even register with an intermediary, which was like formed to regulate the RIAs. So the number of active RIAs would have dropped to about 600, 700. So you can just see that, when you just surely look at the numbers, who's approaching you the most is this 8 lakh people who are selling insurance. Okay, and then when I go to lakhs, it is the MFD, the mutual fund distributor or the banks. And the last is like the genuine advisors. The numbers are very low right now. And that is how our ecosystem is.
Yeah. Before I go into the next question, which is occupying a financial advisor seat, I just want to take in a follow-up on the numbers that you gave and the ecosystem that you just described. To me, it looks like there are basically two types of advisors out there. One that is selling a product and one that is selling a service. Am I right in assuming that? Because, when you say that there are 7-8 lakh insurance advisors, now these are people who are selling an insurance product.
Yes.
Okay. When you say that there are about 1 lakh odd, maybe more than that, mutual fund distributor, they are selling a mutual fund.
Yes.
Okay. And when you say there are about 1,300 total, as per SEBI's website, probably 1,330 was the number when I had it in my book, then those guys are selling a service. Could you just explain the difference between these two for our listeners?
See, it's like, Anupam, I meet you and I tell you, oh, this is a very good financial product and you will get an X return. This is like the number of years you need to invest and Y is the outcome. So my approach is that I have a product and I am explaining that product to you, and if you like it, you will invest. Okay. So this is this one spectrum where they will approach you with it could be insurance, mutual fund, PMS, XYZ. It could be any product. And then there is a second set of people whom you would meet. Okay, Anupam, who are you? Who all in your family? Okay, how many dependents? Where do you stand today in your financial life? Like, or what is your net worth? What are the liabilities? What is the aspirations which you have as a family? So, and here the approach is not Anupam as an individual. It is the family. Yeah. Okay, because eventually we all want our family to reach the life goals, and we say it that swiftly, surely, safely. Okay, so it's all about the approach which you have. And then are we discussing your life goals? Then I'll ask you your investing experience. Yeah. How long have you been investing? Whom are you taking the advice from? What have you read in terms of investing? What is your asset allocation like? And also, what time can you spend in managing your money? Yeah. Okay, so all these factors will be important before I actually even think about a product or a portfolio. Okay, so like I said in the beginning, that out of the 6 pillars, I would first be interested in knowing your goals, knowing your cash flows or the budgets, knowing that are you optimizing your taxes. After that, ensuring that the risk is out. And then coming to actually investing or portfolio or a product, which comes much later. So like I will say that the financial plan, then the process, how will you go about managing money, or how would we do it jointly? And the last is what product will really take you to your life goals. Okay. Yeah. So this is a different set of approach, or a different set of advisors who follow this approach.
It looks like in your case, or rather in the advisor's case, the product comes last, and in case of the product seller, the product comes first. Okay.
Exactly.
Now, like I said, I'm going to switch seats, and I'm going to take up a point that you mentioned in your previous answer, which is that focusing only on returns on the portfolio.
Yes.
Okay. Now, when someone, let's say I'm coming to you as a client and you're the advisor, and all I want from you is just tell me how to make 30% a year.
Right.
Okay. That's obviously, I don't know whether you offer that service. If you don't, what do you tell such a person? I mean, how do you explain to him at least this is my point of view, because I've written again about this in my book, that the rate of return on your portfolio is actually the last thing that you should be concerned about.
Exactly.
Right? You spoke about asset allocation. Can we
Yeah.
just go into that for a while?
Yeah, see, it's like if you put in too little money into something which will give you a very high return. Anupam, what difference will it make to you in your overall life? Okay, so somewhere I feel that people are so disconnected with their life goals and with their overall objective and what they expect out of their money. There is like a huge disconnect. So they'll come with, like, say if their net worth is 10 crores and they'll ask you that if I invest this 2 lakh or 5 lakh and if I get 30% return, I ask them that a 30% return, 72 divided by the rate of return is a number of years in which your money doubles. Okay, so that means your money is doubling, say, every 2 years or 2.5 years. Then in that case, this 2 or 5 lakh will become, will grow, and still it will be like, say, in 10 years 50 lakh or 1 crore. Till that time your net worth is X. What will it make a difference in your overall net worth if you invest a very small amount of money in a asset class which gives you a very high return? Okay, so what you need to be focused on is the asset allocation. And eventually, what is the goal of investing? The goal of investing in the growth assets. So I would like to put it like that we have the growth assets and we have assets which are for capital preservation or earning a little more than inflation. Eventually, why are we saving or why are we investing? We are saving and investing to beat inflation. Okay, so for example, if my living expenses are 10 lakh today, what will happen in, say, 10 or 20 years down the line? The money of value, or because of inflation, the cost will rise and the money of value will depreciate. So at that point of time, 10 or 20 years down the line, when I'm not working, I would want a passive income which will cover the inflation and which will give me a comfortable lifestyle, what I expect or what I'm living today. So eventually, what is the objective of my investing? The objective is to beat inflation. Objective is to maintain my lifestyle without having to go to work, have control over my time. With this, all this, if you are in growth assets, if you earn a little higher double-digit returns consistently for a very long period of time, you achieve that objective. Yeah. Okay, so what investor needs to be focused on, am I actually getting a good high double-digit return consistently for a very long period of time? So that power of compounding will really take you to your life goals, and will take you to your life goals, I will say, very smoothly, peacefully, without being too anxious about switching between the investments, or being too anxious about the markets or anything. So once you are very clear about what is your goal of investing, okay, and you have your reasonable expectations in place and sustainable. The most important word is like, okay, you may expect a 30% return, but is it sustainable year on year for a very long period of time in all kind of market conditions? That is not practical. So I would say that first we will counsel the investor to really understand his life goals, understand his investing objective, and understand that what is important in the long period of time. So we do this exercise and we call this as a prudent growth approach. Okay. That being very realistic and sustainably growing that wealth or growing money over a period of time.
I'm going to ask this question because I don't get women on the show as much as I should. I know it's a mistake and I'm trying to correct it. And even lesser number of RIAs who are women. I had Dilshad, I had Shalini, who were RIAs. And in general, I don't get so many of them on the show. Financial planning for women. Okay. Just some thoughts on it. Why is it unique? Why is it different? Any tips or any advice you would like to give our listeners?
Anupam, it's really
okay. We need another episode for that.
We'll I'll say that it's really very sad that if I were to meet 10 families, generally 8 families, you have the male member in the family, whether the husband or the father, really making financial decisions. And I'm dealing with a universe of professional women, okay, who are so highly educated, who are capable to make money. But when it comes to managing and investing that money, they still depend on their spouses or their husbands, or like their husbands or their fathers or someone to take that money decisions. So this really has to change. It is changing. In the last 5 years, we are seeing women getting more and more aware about the financial decisions. Having said that is one end. But there's something very good about women, is that we are excellent savers. Okay, when it comes to saving, we are very smart. The switch needs to be made from being excellent savers to being excellent investors. Okay, and so simplicity is needed in the whole finance world. At the end of the day, like I said, that every asset class, you have only four underlying. It is fixed income, it is equity, it is real estate, or it's your bullions, right? So you simplify finance, eventually return. Either you have capital appreciation in whatever you're investing, or you get like some kind of a regular income. So again, you evaluate an investment with that lens. And third is like the liquidity. Is the investment liquid or not? What is the risk which is associated? So that 4-5 simple things about investing, if you teach everyone, gender is really not important. We are like now making strides in every walk of life. Okay, so if you simplify finance as a culture or as a community, we involve the women from school, colleges, in the financial decision making of the house. Okay, then things will change. And I think when the financial planning approach, we insist that you need to have your family, you need to have your kids in understanding life goals and understanding as in family what you should spend, what should be like the savings, so they get oriented towards questions around money and around investing very early on.
Very interesting. And I hope that, I don't know, I mean, what's your view on conversations about money that women should have with their partners? I mean, it could be boyfriend, could be husband, could be whoever. If I were to, let me ask it to you in this way. What are the 3 questions that every woman needs to ask her partner, which she probably doesn't in your experience? What would those 3 questions be?
Okay, so we just had like 1 or 2 couples, one of them just recently married and one of them planning to get married. And we started asking them that what were the life goals. So both of them had like different expectation about life goals. Okay, so be very clear that what are your life goals and what is the money associated with that. And same for your spouse or your partners. So be very clear. That itself will make the conversation very easy. Second is budgeting. Okay, if there is an household expense and both of you all are independent and making money, who's going to contribute what? Are both going to contribute? Or one of them is deciding that, I will take care of the expenses and the other one is saving. Okay, so that budgeting is very important. At times, people get married and they get into commitments of real estate with huge loans. Okay, and then they cannot start a family soon because of this EMI burden. So all that needs to be very talked about. Okay, right now it's a double income, no kids, dink kind of a situation. And then tomorrow when you're starting a family, suddenly one income is not there, but you will still have the EMIs or still have a certain lifestyle to maintain. So all that questions should be like very clear. So that budgeting, what I spoke about. And the third thing is that the women needs to be prepared that in case if the relationship fails, or if anything fails, is she financially independent to stand on her feet? Are the investments in her name? Are there like joint accounts? And is the money getting pooled? What if things go bad? Can she stand on her feet? What is her independent net worth, independent of her father, spouse, partner? So I just had one recent case where it was like, a good, well-to-do family, both of them professionals. And the scene was that the husband would actually be making investments on behalf of the family and the wife was spending all her income in expenses. And many years down the line, marriage didn't work out, and now they were like looking at the finances. So the husband just said that, okay, you have a small portfolio, that's what all you have, and I have this X portfolio and this is a liabilities how we plan to. So then the wife came to know a situation that on paper, I don't have any great savings or anything. And now I have to walk out paying the liabilities equally because they had this understanding that you spent. So the loans were on her name. And a certain amount, maybe her husband was ready to chip in. But today his net worth and her net worth is very different. And Anupam, this is a real life case study which I've come across. And now this lady, after so many decades in the marriage and being so professionally qualified, has to build her life all over again.
Man, that's tough.
Okay, so this thing that a woman should really understand how the investments are being made joint, individually. If things were to go bad, can she really access that money for herself? What is that clear thing which is on her name?
Stuff that we just take for granted, huh?
Yes, something which you just take for granted.
You assume that both partners are equal, which might be true
Yes,
emotionally, but when you look
yes.
at the hard numbers, things are very, very different.
Yes, exactly. It is good that if you are also independently
Oh
investing for
yeah,
the
yeah, joint is
wife,
also an option, correct?
joint is
Instead of
also
just
an
single,
option.
yeah. Okay, Nehal, what does your onboarding process look like? Because when you're talking of 6 pillars, let's say that
Yeah.
I've come to you as a client, what does the process look like from the start till we actually start the engagement?
Yes. So we worked out a quiz where we ask you questions out of the 6 pillars. Something as what is your net worth? Do you even know your net worth? The second question is that do you have a retirement corpus, or do you have a number that what will it take for you to retire financially free and maintain the same lifestyle? Some questions around if something were to happen, can your loved one access all your financial documents in under 30 minutes? So we've got a quiz where we take about 2-3 minutes for you to answer a few questions, and that really helps us understand that out of the 6 pillars, do you lack clarity on financial goals, or do you are you not prepared for risk, or do you have an emergency fund or not? Do you need help in estate planning? When it comes to investing, what is your knowledge? So we ask questions around, have you ever looked at the CAGR returns of your portfolio? What does your asset allocation look like? So through the quiz, we understand that which out of the 6 pillars is where we need to work with you very closely. That's a starting point. Then after that, we build something called as a financial fitness plan. So this is like free for all. Just come, answer a few questions like your financial goals, what kind of insurance you have, and then we give you a complete cash flow to meet all your life goals. What is it that you need to save today? How much should it increase every year? And what is your current net worth? And what is the targeted net worth which you need to reach for all your life goals?
Okay.
So this is like something complementary for everyone. With this, we just say that only this much can take you to your life goals safely, surely, swiftly, because we'll give you or calculate that what is that basic minimum amount of insurance needed to keep risk out, what is that optimum amount of savings which is needed, and with very realistic return expectations to reach all your life goals. Okay, we don't recommend any product or any portfolio till now. This is like a basic financial fitness plan which every family needs. Okay, so that is how we start with. Then after you have clarity about your goals and what you have to save, if you really feel that I trust them and I understand the process, then we get into understanding your income, expenses, budgeting, taxes. Okay, then also look at how you've made investments individually, jointly. We prepare the family that in case if there's an untoward event, how will these investments move, to whom do you intend to, right? So all this is quite advanced, which will come in after you really have established trust and you decide to go ahead with us. And after that, actual investing, we will tell you, like we are corporates, so we have both the RIA structure as well as the ARN and distribution and all. So we'll tell you how we make money, whether it is RIA or whether it is like the distribution. So we very clearly list out that how we make money, and then we leave it to you. Okay, what is comfortable for you to choose in terms of further engagement. And if you feel that you've got answers to whatever you needed, you've got that basic understanding, and you're good enough to now just
Execute on your own. Yeah.
execute on your own, we are very happy that even that 1 hour of engagement really makes a difference to the overall approach towards money.
Yeah, well, I was just going to come to that. What are your fees, and what do you have an option where that if I want to execute on, because that I've seen both types of clients. One that says that I don't want to execute, I'm coming to you, so you please do everything for me. Okay, and that's also
Yes.
perfectly valid. And then there are those who say that okay, just give me the advice part and I'll execute on my own.
Yes.
I have my own broker, I have my own mutual fund person. So how does your income structure work, and what are your fees?
So, like I said, that the first financial fitness plan where we just help you understand your life goals and what savings you need to do, and like the basic insurance which you need, that is completely complimentary.
Yeah.
Now, after that, if you really want us to manage money, then in that case, like I said, that we say that if you give us anywhere between say 1 lakh to a crore to manage, then a percentage of that is a fee which we take, 1 to 3 crores, 3 to 5 crores. There are slabs like that, and also on the amount of engagement. We are generally working with extremely busy people, successful and busy people. Today, their pain point is that they are looking for genuine advisory. They don't mind paying the fees, but they don't know where to go to. They're always at the risk of being missold something which they don't need. So there is a something available for them where they would want you to do everything, and they don't mind paying your fee. So we have that model. And the second one is that a person or a client is not very sophisticated, not very aware. He's not even got his basics in place. He really doesn't understand what is a fee, what is so a simple mutual fund distribution till a certain amount of portfolio is okay for him.
Sure.
Because if he just has to invest like 5-10 lakhs, RIA fee starts at a little say higher level. So for him, just being in a simple distribution structure is also okay, because that also starts out of understanding life goals, putting the risk out, and having realistic expectations about returns, and having a path chalked out. Okay, so to us as a service, it really doesn't matter how we are rewarded. Eventually, what our objective is to take a family to the life goals in any and every situation, and that is what we focus on. Naturally, if you are running a business, you would be rewarded. And how you are rewarded, what I feel is that what customers really look at is transparency. Okay, so we very clearly put out that how we make money in every single recommendation which we give, and that there is a process to how your portfolio is constructed. There is a lot of research which goes into it, and we explain that process. Okay, that helps build trust, and even the client is involved in the decision making. I think once you involve a family in decision making, a lot changes. And continuously educating them. I think people don't mind paying fees, or they really, whether you take 0.5% directly as fees, or whether as a distributor you're rewarded that 0.5%. But what they need is they need to know how you're rewarded. What is it that you're getting? So the transparency is what I feel is very important when you're dealing with families.
And the fees are also transparent out here. Like
Exactly.
Even, and I think they're also regulated. At least the RIA part is regulated by
RIA
SEBI.
is also regulated. MFD is also regulated, right? No mutual fund can decide on what AUM they will pay what, right? So
Correct.
I think fairly it's regulated. What we need to bring is transparency. You need to teach or make the customer aware how is it that you make money, what is the cost involved for them. Like I said, that cost, risk, underlying asset class, the liquidity, in that investment. So if you make them aware of these things, then they are really fine about it. And I'll just share my perspective that RIA is a great, business model and all. But I told you the challenges of scalability. Now, for an organization like us, we want, most families to be financially fit. So given the regulations and challenges, it's really difficult to scale up our RIA. So does that mean that we should not be doing the right thing? It's not like that. We want to take maximum family to the life goals. So even in the distribution setup, no customer doesn't mind paying you half or 1%. It will not make a big difference to him whether it's 18 or 19 or whatever in the long run. Like for example, when we do financial plans and the targeted net worth for a family is say 30-31 crores, after adjusting for our fees, okay? What is more important that we took him to that life goal of 30-31 crores. We took the risk out. We ensured that, the estate planning is in place. We ensured that he had realistic expectations. We freed up his time for him to focus on his profession. And whereas we helped him in managing money. So there is a lot more aspects to actually advisory, and not just being too caught up about how you're rewarded or how much. The transparency, I feel, is the most important thing.
Yeah. So I want, before we wind up, a lot of people and quite a few of our listeners also are probably young, just starting off their career, let's say, and obviously they don't have the kind of AUMs to come, and go in for a service like yours because it's a little bit early. Maybe they'll come to you 5 years later, 10 years later. But for someone who's just starting off on his finances, maybe his first job, what would be your advice to him in terms of, basics that they need to get right when they start their financial journey? What
So
would be?
Anupam, everything in life is about having good habits, whether it is physical fitness or whether it is financial fitness. So one good habit is that when you're earning, you ensure that you're saving first. Okay, if your salary is small, it's okay, it could be 10%. Ideally it should be 25-30%, but someone who has small families, he has lot of needs and wants. Okay, there will not be much left to save, but you mentally need to make a note that okay, my salary is 10,000, I want 9,000, 1,000 I will save as a discipline. Okay, so that habit or the discipline of getting into savings is very important. Okay, so get that mental note that I earn, I save, it could be any percentage, and then I spend. And when I'm spending, classify or bucket something which is need, wants, and luxuries. Okay, so make a list that what I spent, was it something which I needed, or iPhone, or a luxury vacation, or so all these things. So can I actually do away with this because these are luxuries, these are not that absolute necessities. So this one or two things, if the youngster keeps in mind, that getting into this habit of saving regularly and being mindful about the pattern of expenditure between, say, needs, wants, and luxuries. And if you can postpone the luxuries and increase the savings. Having said that, it's not that you're not going to spend on a car or a house or a luxury vacation. It's not like that. It's that you have your budgets in place. You have a saving budget in place, and then what is left? If you're left with surplus, why go and splurge, live a life in today. I really don't believe that just saving everything for the future. Okay, you need that balance. We are also living in the moment. We don't know what the future holds. It's so uncertain. Okay, so living in that balance is very important.
Okay, lovely. Our last standard question to all our guests: what book are you reading, and do you have any recommendations to our listeners?
Okay, so currently I'm reading this very interesting book, which is Good to Great Companies, and it has a very good study about why some companies make that switch from being good to great. And right now the chapter which I'm reading is on leadership.
Nice.
That companies which have leaders who are not stars, who have personalities who underplay themselves, and who always have the interest of their organization above their personal interest. Those are the companies which made this switch from good to great. So a very interesting book. Everybody who's an entrepreneur, I would surely say to read this book. And generally, in terms of investing, for everyone who's just beginning, Psychology of Money is something which I feel is so simple, so easy to understand. And everyone who's starting out their investing journey should definitely read this book.
Wonderful. So that's Good to Great by Jim Collins, I think.
Jim Collins.
And of course, Psychology of Money by Morgan Housel. And that is a wrap on this episode of Paisa Vaisa. My guest, Nehal Mota, co-founder, Finnovate. Nehal, thank you so much for doing this for our listeners.
Thank you so much, Anupam. And it was really interesting to discuss these real life stories with you. And I surely look forward, that we once again come together and bring out some interesting stories and real life case studies which we come across always.
And lessons.
Yeah, lessons.
From those case studies for listeners. Folks, we're going to be working on that very soon, something maybe early next year. And I look forward to having you back, Nehal.
Thank you so much, Anupam, and thanks to all the listeners. It was really interesting, talking to you and connecting and discussing everything about personal finance.
Sure. Thank you, Nehal. And listeners, you can check out other interesting podcasts on the IVM network. You can also follow us on our social media. We are IVM Podcast on Twitter, Instagram, LinkedIn, and Facebook. If you want to reach out to me, I'm your host, Anupam Gupta, B50 on Twitter. And thank you, folks. Really, thank you so much for listening to Paisa Vaisa.
IVM.